Hey, this is Michael and welcome back to me and Paul's channel. In this video, we're going to talk about common acronyms that are used in real estate investing. Before we start though, if you guys are new, we have two videos coming out every week and we talk about everything real estate, such as buying real estate, selling real estate, and all the strategies we use like virtual wholesaling, rental properties, buy, fix, and flip, owner financing, private lending, and more. If you haven't already done so, please subscribe to our channel. So let's get into today's video now on common acronyms that you'll come across as a real estate investor. Here, sort of in alphabetical order. Let's start from the top. ARV stands for after repair value. What that means is, when you purchase a property, example as a rehabber, you buy it cheap because it's a rundown property or just dated. And after you renovate it, what can you sell for? So think about a brand new renovation project. What's the top dollar in the market that you could get for that type of property? So that's after repair value, or ARV. BPO is another word, an acronym for broker's price opinion. And that's an example where, like, for example, when we're buying REO properties, sometimes the listing agent for the REO property will have a BPO, basically what they think the as-is value of the property is that will sell in like 30 days. So that's just the opinion of the broker there. Another one is CF, is cash flow. This is used for more rental property or income property analysis. So you take your rents minus your expenses, taxes, vacancy ratio, et cetera. And then from there, subtract off your debt service. So what's your mortgage? If it's like a rental property, and that net number, then if it's positive, you have positive cash flow. If it's negative, you have negative cash flow. So that's what cash flow is. And then CFD stands for contract for deed. Also known as a land contract or owner financing. And what that means is, if you're selling one of your properties and selling it to someone that has a loan to purchase it or for cash, you essentially become the bank. You sell them the property, and you'll collect their down payment, and then you create a note, and they'll pay you back the remaining balance over time with interest. So that's what CFD means, contract for deed. Another one is CMA. This is something an agent will provide you, a comparative market analysis. So if you go to an agent for comps, they'll sometimes run you a CMA where you get a bunch of property analysis, essentially from comparable properties in that market. COC is kind of a cash on cash return. It's another way to evaluate an income producing property using that cash flow analysis above. You would take that cash flow number and divided it by what you're all in, how much cash you put into the property, for say. Another one is EMD. It stands for earnest money deposit. So when you're buying a property, you have a purchase and sale agreement with the seller, and then you also have to hand in your earnest money deposit. It could be a few $100, a few $1,000s, depending on what you negotiate and what's the cost of the property. Another one is common is FHA. It stands for Federal Housing Administration, government agency. FNMA, it's short for Fannie Mae. So if it's a Fannie Mae backed mortgage. FSBO stands for sale by owner. So if someone's selling their house not through an agent, it would be a for sale by owner. HELOC is home equity line of credit. This is where, let's just say your house is worth $400,000 and you have a unpaid mortgage balance of $200,000. You could probably get a HELOC of at least like $150,000 up to $200,000 on that property. So it's basically utilizing the equity in your house that isn't loaned out. Another one is, and going back to HELOC, this is a great way to fund real estate projects. So if your primary properties pay down a lot and you get a $100,000 HELOC on it, you could use that money depending on what your rates are. Rates are pretty low right now, so you could get something sub 5% on a HELOC, and then you could lend it out for private lending at 12%, or purchase a rehab project and then pay yourself back the HELOC when you're done. So it's a great use of capital to tap into. HML stands for hard money lender. This is a lender that when you need cash fast for a project, you're gonna have to pay probably 1 to 3 points up front, and then probably like a 12 to 15% interest rate. However, it's a great use of capital, even though you're paying a lot for it, because it's quick. And it's almost especially if you're starting out in real estate, it's a good second set of eyes to make sure that the deal you're buying is a deal, because they're going to do their own due diligence as well, the hard money lender. Another one is certain properties are in HOAs or homeowners association. So it's an extra monthly payment you should be aware of, but you might not have to, mow the lawn, or you get amenities like tennis courts and pools with being a part of that community. And that's what that pays for. HVAC stands for heating, ventilation, and air conditioning. So that's just your heating and AC unit system in a property. HUD is a government agency, housing and urban development. JV, so if you want to partner with someone, it's short for joint venture. It's a one-off. You don't have to create a formal partnership, but you might create a simple JV deal on a single family property real quick to fix and flip. And it's a one-time thing. LLC is a limited liability company. So it's just a way for asset protection and to create a corporation and run all your revenues and expenses from it, whether it's a LLC for a single family property that you own, or you do a bunch of wholesaling or flipping, buy, rehab, and sell. You can run it through an LLC that you have. LOC is a line of credit. So it's, similar to the HELOC that we talked about earlier, except for your house. This isn't your home equity line of credit. This is just could be a business or personal line of credit from the bank that you could draw from to fund real estate projects. Some people use LOIs before they sign a contract. It's a letter of intent. Basically, they'll submit a one-page LOI saying, I will purchase this property for X. Give me a few days to do due diligence. Another one is LTV, or loan to value ratio. It's more on banking. So if the property is worth 200K and you get a 100K mortgage on it, the loan to value ratio will be the 100K minus the 200K, which is 50%. MAO or MAO is maximum allowable offer. So that's when you're doing your own analysis. Let's just say it's a single family property, and you know what the ARV is, the after repair value. You know what the repair renovation estimate is going to be, and you know how much profit and holding costs are that you want. That, subtracting all that out, will give you your maximum allowable offer. NAR is National Association of Realtors. MLS is the multiple listing service that realtors put their properties on for sale. NOI is net operating income. So it's similar to what we talked about in cash flow above, but with this it's basically the income property that you have. It's the rents coming in minus the expenses. That will give you the NOI. It doesn't include the debt servicing that we talked about earlier to get to that net number of cash flow. PITI also stands for principal, interest, taxes, and insurance. So that's like your monthly mortgage payment that you're used to if you escrow your taxes and insurance. POF stands for proof of funds. So if someone asks for a POF and you're making a cash offer of 200K, do you have a bank statement to prove that, or a letter from a lender to prove that you have the funds to close on this deal and make that cash offer? REI, real estate investing. RIA is a Real Estate Investor Association. There's a national RIA website that you could go to and find local Real Estate Investor Association groups in your area that you can network with other real estate investors. And then they also have vendors such as agents, different real estate service vendors, like from repairs to attorneys to insurance, etc. So it's a good group and great way to network with people. REO stands for real estate owned. So this is a foreclosed property. Once the property goes through sheriff's sale, and if no one bids on it, it goes back to the bank. And once the bank owns it and clears the foreclosure process, it is now called an REO property. ROI stands for return on investment. Just another calculation to see how much you're going to make on a property. And the last one that was covered today is sub 2, or it stands for subject to existing financing. So an example here is if you're purchasing a property and the person has a loan left on it with a really low interest rate, and you could, instead of finding the cash to buy them out, you could take over their mortgage payments. You probably have to give them a few $1,000s down to do this. And then it's a great way to buy rehab projects. So you don't have to fund the whole amount. So you could take over their existing loan. And then after you fix it up and sell it, you could pay them back their loan in a few months, and you collect the profit, anything over that. So Sub 2 just stands for taking over someone's existing mortgage payments on a property. Hope this video was helpful. All the acronyms, if it was, smash the like button and subscribe to our channel. If you have any questions, feel free to write them in the comment section below and we'll get back to you guys. Thanks and have a great day.